you so much, everybody. My next speaker is a good friend of ours and a regular at any. I don't dare to do a blockchain conference without calling Mike. He's not only the blockchain's fastest talker, he also knows what he's talking about. I remember Mike was speaking at our last conference at the World Trade Center. He said that he thought Ethereum was too expensive. He said that he thought Bitcoin was a little bit high as well, and Dogecoin. And Mike, I can say that what happened later, I mean, basically a week later, not long time afterwards, everything came down, as you all know, if you've been watching what's going on with Ethereum and Bitcoin. And since this market is so crazy, Mike, senior commodity strategist at Bloomberg Intelligence, is always here almost every month to keep us up to date and give us a little bit of logic to what the hell is going on in this crazy markets, or not so crazy. So, Mike, take it from here. Good to see you.
Hello, Danny. Good to see you, and thank you for that kind introduction. And I appreciate you kind of glossing over the fact that I missed the market had peaked. Now, that's one of my jobs as being an ex-trader. I try to pick bottoms and tops. And the goal I used to learn in a trading desk 30 years ago coming to Wall Street was you want that 70% in between. And my focus is always the big picture, but I didn't really think Bitcoin was going to drop towards 30, but it did. And I fully expect it to recover. And I'm looking forward to sharing my latest outlook because I just published it today, and I think that's where we're going to go, if that's okay.
Sure. Thanks from here. We'll hear about Ethereum, about Bitcoin, everything, what's going on and what you think is going to happen. Thank you.
Right. Perfect. So I'll start with sharing my screen, and I want to start with something completely different, just as you expected, because you think I'm talking about cryptos. I am, but I want to start here. The U.S. 30-year yield. To me, this is the most significant development that's been happening later. If you do a simple, I'm actually just taking you right to the Bloomberg terminal. You see, this is just a year. And it looks like yields went up and then going back down. But there's one simple little function I like to say, okay, how to define that trend? I just click on this thing called max. And there's a trend in 30-year yields. Going back 40 years. This right here is when I got promoted to come to Wall Street, 1993 or so, because I kept calling for yields to go lower, bonds to go higher. And all the people in New York, and mostly as I work for New York, disagreed with me. But here we are. What does that look like to you? That's a trend. 30 years breaking below 2%. To me, that's a significant development because I want to ask you and your audience, is anybody who's not heard from their financial advisors that you shouldn't be buying bonds because yields are too low? And I know the answer to that question, but I just ask yourself because that's why I'm bullish bonds. And I think yields are going to continue to go lower because here's the trend. And I rope that into cryptos because to me, that's the key development in 2H. To think about 2H. And you're really seeing that on screens this morning. It looks like crude oil's peaked, bond yields probably peaked. And if the stock market, it basically has to go up 15% last quarter. It's basically actually the first half of last year. That's actually a very good year. The average annual year is 8% or so. So we do another 15%, that's great. But to me, that's the narrative to look forward to in the second half. And I fully expect Bitcoin and gold to be the best performers in 2H, along with long bonds. And now what I'm saying is, to me, the long bond is indicating to me and to us that there's greater risks toward deflation in the market. And the long bond for me is one to watch, partly because there's only 136 basis points left on the 10-year. German's a negative, Japan's flat, and there's still 200 basis points left in the 30. And this was one of my key indicators last February 2020, when the long bond dropped to lowest yields in history, which is February. It was right before the collapse of the market. So I'm bringing you into my latest outlook, and here's my headline. I think 30,000 in the Bitcoin as support, and long bond 22% will define this year. In crypto assets. And I have three key sections I really focus on. Bitcoin to gold, I expect to shine in 2H. Remember, gold was the worst performing commodity in the first half of this year. And guess what? Today, it's one of the best performers. I think volatility is going to continue to decline because I think Bitcoin's stuck in a range, most notably probably moving higher. And I see a building foundation for Ethereum. So I can pause there or just move right into my first chart and outlook, if that's okay. I'll do that.
Sure,
so here's
thank you. I just put it on mute so I don't disturb it.
Okay, cool. So I fully expect Bitcoin and gold to rule the second half of 2021. with some long bond companionship. As I showed you in the start, that long bond, if it keeps staying below 2%, it's telling us something. It did last year. And it's, you know, the world's deepest market. And it's always, to me, long bonds that give you some of the best indications for longer term trends. So my first outlook here, first chart shows the long bond in white overlaid with Bitcoin. Bitcoin's hovering around the 30,000 levels, holding that support, which also is right around the 12-month moving average. Nice to see a bull market that's consolidating, ready to break out higher, and yields potentially putting in a bottom like they did 2018. And this is the inverse of the chart, and potentially putting in a bottom again like they did in 2020, and potentially breaking down below 2%. Again, I'm showing you inverse here. So to me, this is just more likely that yields are going to continue lower. I showed you that trend, and Bitcoin is going to continue higher with less competition, like gold. What's the best thing for gold? When it has less competition right now from bond yields. At least historically, and more last few years, that's been the key thing. And in the past, it used to be inflation, but to me, the greater risk is deflation. So in a similar note, I want to show you, this is performance of Bitcoin and Ethereum and the Bloomberg Galaxy Crypto Index. It's the beginning of this year. And at the end of, basically as of last Friday, July 2nd, Bitcoin and the S&P 500 were both up 15% on the year. Now their Bitcoin's up a little bit more, but it's within a rounding error. So I fully expect Bitcoin to outperform the stock market in the second half. But I do see underpinnings for the broader market. Bloomberg Galaxy Crypto Index ended the year up 80%. And Ethereum almost up 280%. So I don't see why that should really end. And I fully expect, I see what we've had is basically discounted bull markets, and markets should continue to rally. But there's two key things to point out here is the stock market just too hot and Bitcoin too cold at the start of the second half? So there's fundamentals and technicals. I view the fundamental underpinnings for Bitcoin as quite solid. Declining supply and increasing demand. A lot of that's coming from, we've had a major pushback in price for some major short-term reasons that are very bullish, i.e. pushback from ETFs that's been delayed in the US, just a matter of time. The issue with China and them pushing back on kind of more almost banning Bitcoin, but certainly pushing back on miners, which has created selling. And then the issues with ESG. But so here I just show you a simple technical analysis. Here we look at the S&P 500. It's the most stretched above its 50-week moving average in a decade. Over 15 to 20% for a while, 15%. So just a little mean reversion there is a big issue for the stock market. And then I look at Bitcoin, it's basically right at its 50-week moving average, which is the annual mean. And historically, that's proven to be a pretty good place to, basically it's proven that sellers definitely historically do not do well at those levels. So there's some technicals, just the relative value. And then kind of my second key theme for this month, it's actually the second, the mid-year outlook for basically for 2H is volatility is probably going to decline in Bitcoin. And here's the main reason. It's bumping up to really good support around 30,000, and it has very good resistance around 65,000. So I'm not saying, I think eventually we'll break above that resistance, but not in the short term. And typically Bitcoin volatility goes higher, bids when market breaks out to new high. I mean, it's uncharted territory. So that should be a while, but I see it as a very well supported market. So that giant sucking sound is my headline, maybe volatility leaving Bitcoin. And here's one trend I want to show you. In white, I show you 260-day trend in Bitcoin volatility divided by the S&P 500. Now, when I was at a hedge fund, we measured everything versus the S&P 500. It's the world's benchmark for investment. It's a US benchmark. And so here I'm just measuring the volatility measures. So what you see is a pretty solid foundation for this year. Last year, the volatility in Bitcoin dropped to the lowest ever versus the stock market. Now it's recovering. Now it's happened in the past. If past performance is indicative, when that happened in the past, it was 2016, when it dropped down to about 2.7 relative to the S&P 500. Now we had a massive rally in Bitcoin market cap. So I show Bitcoin market cap around 600, just around $600 billion, probably likely to have over 1 trillion. It has pretty good solid underfittings if volatility is an indication. So this is what I show. And I fully expect that to continue. Another thing is what you're happening is in futures markets. Excuse me. There's been a pretty steep contango in futures. That means when further out prices are at much higher prices, that's been armed out. Now, some of the reasons armed out, I think, is because hedge funds and more significant players are getting involved in the space. But it's also indicative of what we should expect as volatility continue to decline, because there's more and more depth pushing prices lower. Not so much pushing, but arbing out some of the volatility. So this is what I show you here. This was the first futures curve versus the third futures curve. It's come back to first future versus the third future. It's come back to basically flat. And that's been the first time in a while. Excuse me. And I caught a little bit of a cold this weekend for 4th of July celebrations. But so it's come back to flat. And to me, that's just the arb. That's people pushing the excesses out of the market. I.e., we have a pretty significant discount in the Grayscale Bitcoin Trust. I think as more players get involved, those arbs, those extremes will get pushed out. And this is just one example of volatility declining because of more participants pushing out this steep contango in futures curve. And I think it's indicative of what volatility is going to do. More players are going to do. It's going to make Bitcoin more of an adult market. One thing I want to show you, this is a chart I used from the past. And again, it's similar to the first one. This is Bitcoin 260-day volatility divided by gold 260-day volatility. Now here at the beginning, that's when Bitcoin was very much of an infant. And it was running around basically 12 times the volatility of gold. Last year, it dipped to 2 times the volatility of gold, only twice. So what is this? This is purely an infant. Now it's a maturing asset class. But when last time it dipped to such a low level was when the Bitcoin to gold ratio, I'm just dividing by Bitcoin by the spot gold, was bumping up against 1. And when volatility bottomed to this all-time low, which we reached again last year, it just went from 1 to 10 versus gold. I fully expect it's going to go from 10 to 100 versus gold, partly because of this indication, because the fundamentals are quite favorable. Now, not bearish gold, but Bitcoin is in that price discovery stage. And this is just indicative of where prices are going with discovery, i.e. this overall trend should continue lower. But in the meantime, we're in the process of bouncing from a much lower level. And in fact, this level here was the lowest ever that Bitcoin volatility ever reached versus gold. Now, I use 260-day volatility because it's an annual measure. And I always want to keep the focus on the bigger picture. Going into Ethereum, Ethereum is number 2 on the crypto space, and it's one of the best performers this year. But I view it as finding very solid footings around $2,000. It's stuck in a range between $2,000 and $4,000 for a while. And one good way to measure Ethereum is versus addresses. Here, you can see the trend is clearly upward. So addresses used, I get to some coin metrics. I take a 30-day average, so it's a bit of a delay. But you can see when addresses used broke above the old high from 2019 and 2020, and this one was Ethereum was around 300. It was indicative of a price rise. So it's also indicative of the rising tide of the use of Ethereum. Ethereum, I look at it as it's the building block for basically the whole crypto space and platform. DeFi, decentralized finance, decentralized exchanges, and fintech. And it's winning the battle versus a lot of its competitors. So I see Ethereum is very fairly priced around 2,000 if you just look at an auto scale basis versus addresses used since 2018. And this has been one of my robust indicators. This indicator kept me very bearish in the market in 2018, most notably in Bitcoin. And then it got me very bullish in 2019 when it started breaking higher. Not so much in Ethereum, but now well, it was Bitcoin back then, and now it's Ethereum. So I see fully a bull market that's just backed up into a discount for Ethereum. One other way, a simplistic way to look at Ethereum is relative to Bitcoin in 2017. Now, this is something I originally got from Raoul Pal, and I'm just showing you here in white. This is a chart of Bitcoin in 2017. Yes, it's very simplistic. It started around 1,000, it peaked around 17,000. We all know what happened. Ethereum started just below 1,000, around 700. This year, it's peaked so far just about 4,000. And if you look at it overlaid with that same chart of Bitcoin in 2012, Ethereum looks at a bit of a discount. I showed you the other charts. So it looks like Ethereum's in fair value. But based on this simplistic way to look at number 2 Ethereum in 2021, or now, it looks at a bit like a discount versus the way Bitcoin traded in 2017. So around 2000, if it just gets up near 4,000 highs and stays there till like October, it's on fine. It's meh. It's just what Bitcoin did. And then of course, we have a styled correction, but I see a bull market that's transitioning. The key thing to think about Ethereum is it's going through this improvement proposal, the EIP 1559. Now that's nothing to remember about Ethereum. It's very nascent technology. The proposal is supposed to reduce supply, and which would be significant because that's what I showed you in orange. In orange, that's just Ethereum supply. Now it's harder to measure, but basically it's been increased on an annual pace of around 4% a year. Now overlaid with that is Bitcoin supply. Now the key thing about Bitcoin supply is it's by code. It's dropping below 2% this year, 2% of total. And then it's going to continue to decline, certainly as we get to the next halving 2024, by code defined. Ethereum's less defined, but if this new proposal works out as well, remember, it's nascent technology, it's something new and different. If it does work out, Ethereum supply will drop to near zero or potentially below that of Bitcoin. Now, some of that's getting priced in, obviously, but again, it's an if statement, which I guess I'm kind of biased that it will work out because I've been working on it so long. With some pretty solid, smart people, as I keep hearing a lot of smart people in this space, then that's part of the bias of Ethereum, becoming the platform for space. And if it's annual volatility because of the EIP 1559, the new framework, the improvement proposal works, its supply will drop below that of Bitcoin. There's a key thing I want to point out this year. I published earlier, but I just kind of rehashed it initially, is the pushback from China in Bitcoin. I look at it as very bullish. Short term, it's bearish, but it first of all, it alleviates one of those key issues we've had in Bitcoin. I've heard that a lot of the mining concentration, hash rate was concentrated in China. Now that's shifting. There's a major shift away from China, obviously, because they have to. Because of that, in the short term, they have to sell. It's very discombobulated. They have to sell, and they have to raise capital to do what they want to do to move. But I view this, the Bitcoin and digitalization of money, it may mark potentially an end to China, or not an end, but a major peak from this Communist Party that repressed its people for 50 years. In the last 20 or 30 years, finally lifted them back up to nowhere near nor westernized levels, but that's completely a surveillance state and more of a communist dictatorship. But there's very little way they can keep up with the more open discourse and open free market capitals of the Western world is what I see happening in digitalization. And they're finding that out organically, because the digitalization of assets is enhancing dollar dominance. And that's what I show you organically, which is very unique. And I think I like to ask my audience is, do you know of any digital tokens where the trades in the yuan of any size, or the euro, or the yen? No, it's all dollar. And the most widely traded crypto on the planet is an Ethereum token, and it's Tether. And to me, I look at that as indications. Now, yes, it's very controversial, but I'm a strategist. I look at rising volume and rising market cap as indicative of what's happening in the space. And that's what I show you in the chart in white. This is just Tether market cap of Tether. It's running around $63 billion, but clearly look at the trajectory, overlay that with Bitcoin monthly and the Chinese renminbi in inverse to show its relative value. Just, you know, because that's also a manipulated currency. But here is what's happening globally. There is no measure on cryptos of Chinese renminbi traded. No one wants to trade it on this, one of the most freest markets examples I've ever heard and ever seen of free market capitalism on a global scale are these cryptos that we see trading globally. Yes, there's massive speculation, but they're completely free markets. People trade what they want to, not what they gotta. And the Chinese want you to gotta use their currency, but it's not working. So here's the dollar gaining dominance globally, digitally. And I see this as a key factor that's happening on a world scale that's really pressuring China and point out some of the major issues with them going forward versus the last 10 years when they just lifted from virtually zero, fractional level of per capita GDP to levels that are more respectable. But also what it's done is it's plunged the Bitcoin hash rate. That's what I show you in white. And typically I would say there's not a high correlation between the Bitcoin hash rate, but there's a longer term trend between with the Bitcoin hash rate and the price. Now I show you here is a 10-day average of the hash rate. and the weekly chart of Bitcoin. Now it's back to near its 52-week average. It's at good price. The hash rate is plunged to the lowest level since over a year. But I view that as indicative of not so much the weakness of the price of Bitcoin, but just what's happening with this situation in China. And it's a one-off. It's unlikely to last as all the miners migrate, most notably, a lot of it, to the U.S. to this free market capitals, and where they don't have to worry about being banned. It's the rule of law. And that's what I've heard a lot from the miners and some of the people in the space is they're going to go wherever they can get cheap energy and not have to worry about disrupting their businesses. What I want to show you here is, to me, a key thing that Bitcoin helps alleviate. This is this race to the base. And I find it significant. On the bottom, I show you the U.S. trade-weighted broad dollar. Now, this is for the last 21 years. It's up 6%. It's nothing. Why? Because let's overlay that with, here's the money supply change in Europe. This is in Aqua. It's up over 300%. And the money supply measure, the similar measure in the U.S. is up about the same. It's the race to the base. So, for instance, this morning on Canada TV, I was asked about the value of the dollar versus a trade-weighted broad dollar. I'm like, okay, well, I look at the dollar as basically this, how Churchill described democracy. It's the worst form of government except all the others. The dollar to me is the same way. It's the worst currency except for all the others. So it's probably going to continue to appreciate in value versus the other currencies, but not versus Bitcoin and gold. I fully expect them to continue to appreciate. And that's what I show you here. I show gold is up 500% since the start of that period. And then look at debt to GDP. Debt to GDP in the US is running 130%. So a key question we ask ourselves, is M2 going to drop? And is debt to GDP going to stop going up? Very simple. We all know the answer to that. They're most likely to continue to accelerate, most notably if the stock market stops going up. And as if that chart I showed you earlier matters, the US 30-year continues to decline because the government can buy them. And this is a chart, it's a subject I touched on earlier, but I would kind of want to make sure I hit hard on, and that is digitalization of money is here, and the dollar is the top dominant currency on the planet. It's not Bitcoin, it's not the yuan, it's nothing else. The dollar is gaining dominance. Global digital currency, a global currency going digital, it's the dollar, and the global digital reserve asset. It used to be digital reserve asset used to be gold. Now it's all becoming digital gold and Bitcoin. To me, that's the trend I show. And here's just the Tether market cap. I show it this time. I didn't show a log, so it's very much convex. The U.S. trade-weighted nominal dollar is up 30% since the start of for 10 years, and the Chinese yuan is basically unchanged. And one thing I want to kind of finish on, and that is, to me, is Bitcoin's migration into the mainstream really means institutional portfolios. And that's where I point out Bitcoin and bonds are tremendous companions. So let's look at the global portfolio bonds. Anybody who's held bonds, the world's largest asset class next to real estate, and certainly above equities, have the lowest yields in the history of mankind, and negative in most of the world. Let's look at Japan and Germany. So I just did a simple correlation and testing that, point out the yin and yang of bonds versus Bitcoin complements their companionship. So I just created a simple index in the Bloomberg port function where I show the Bloomberg Barclays 20 plus treasury bond index. I use 10% of an allocation to Bitcoin. Now that's kind of high, but I wanted to point out is if you add Bitcoin to that allocation, and at 10% rebalanced quarterly, I go back 5 years here. What I show you here is a volatility of this Bitcoin index that I created, which is 90% bonds, 10% Bitcoin. I went high intentionally to accentuate the volatility. It's actually lower and clearly lower than the NASDAQ. That's why I show you very similar performance going back to 2016. So to me, yes, you can fully expect this rapidly rising asset when you put it in our portfolios and increase performance, but it also reduces volatility. And that to me is the key thing that portfolio managers are picking up on. And that's what I show you here. The volatility of this index I created, which is bonds and Bitcoin together, 10%, is about the same as bonds on a standalone basis. Now, how can that be? Bitcoin's so volatile. It's because of negative correlations. And again, that's 10%. So to me, the world's picking up on this. And every asset manager on a planet that's not allocating to Bitcoin realizes, well, their greater risk 5-10 years from now may be looking like they have their head in the sands and they missed out on this next big thing. Not by just by allocating 1 to 2%, to at least say, hey, I have a prudent reading to reason to add it to my portfolio, and I fully expect And in worst case, you lose that 1 or 2%, but if you continue, you're fine. You've looked like you've at least done your job to be ahead of the game and be smarter than your average 22-year-old who figured out Bitcoin 5 years ago. Because they're young and naive, it sometimes helps. So here's why I point out the companionship. Just pointed out the Bitcoin, close relationship between Bitcoin and bonds, the generic 30-year yield, and the bond market. And I want to end on this chart. It's one of my favorite charts. What problem does Bitcoin solve? And that is what I show you in white is this U.S. money supply since 2017, clearly breaking out higher. So where is that going to end? I look at this, I'm like, what's going to end the U.S. money supply from just continuing to rally rapidly? I don't know. I'd love to see your take on that. And juxtaposed with the money supply increasing is Bitcoin supply declining. Now, this I just showed the annual rate. It's running around, well, less than 1% by 2028, about 2% this year for the first time ever, and 2% significant because it's the price for gold. It's basically the annual change in gold supply. With that, I can go back to the beginning, and Denny, see wherever you want to go. I think we have a few minutes left.
Thank you. So you're saying Ethereum you think is discounted, so you think we'll see it at the same level we've seen it by the end of the year, the 4,000 levels?
Oh yeah, I think it's going to continue to rally. Like the key fear about Ethereum is the potential lowering tide from the stock market, because I look at the broad crypto market. It's very similar to Ethereum to the Nasdaq and this rising tide of reflation. Yet Bitcoin's the opposite. In a short term, let's say if we have a short term correction in the stock market, everything drops. But like gold, it looks better because what happens to bond yields and Bitcoin will shine. Ethereum, I'm very bullish. I fully expect it's going to continue towards the 4,000 level, which is the first good resistance.
And maybe last question, I asked somebody else today the same question. I think one of the problems of the market is that with all your projections, then comes along a Musk and he wakes up on the wrong, on the wrong day and says something and influences the market. And my question is, how can he influence the market so much? Because it's not only Dogecoin that obviously serious investors don't go to. We thought that the actual market today has more institutional, sophisticated wealth that doesn't care about all that crappy remarks or whatever. Sorry, pardon my French. And yet he still manages to influence this huge market by saying Tesla will buy, Tesla will not buy. Isn't that a danger that the market can be influenced? Where I come from, you might call it stock manipulation, but maybe it's just a game. But still, isn't it more institutional wealth out there? If so, why is it such an effect?
It's noise within a broader trend, and I encourage people to ignore it. I do. Sometimes I'm asked to respond on TV and radio and reports to it, but I focus on the bigger picture, like right here. I show a monthly chart, and I show a Bitcoin ready to break out. What any tweet might do within a day or two, you're not really supposed to care about when you're a long-term investor focused on accumulation. And if some of these tweets, which I think has happened now, provides you a discount in a trend, I think it's better probably to add to the allocation. And if some of these tweets get it too expensive, maybe lighten up a little bit. But that's for the more active person. I view that as let the noise and let the traders beat themselves up, ignore the noise, focus on the big picture. And this is what I show you here. And to me, in the long-term trend is forget the noise, focus on the big picture, which is to me defined with this final chart here. So I view it as just try to keep your hair and look at any type of these dips as from something that's like happened lately when Mr. Musk focused on the energy uses that was very much unfounded. If you look at the ESG benefits of Bitcoin, they're tremendous. I mean, they allow people, allowing people and your average person in most of the unbanked in the world get banked to get access to this digital reserve asset. Look at El Salvador, just getting started. Most of Africa, just getting started. So to me, focus on the big picture and what's happening in the space and ignore the noise.
Mike, maybe last questions I have here from Colonel Abbas Tahouk, a good friend of ours, and it's nice, very much relates to 4th of July. He fought wars and is one of the highest generals in the U.S. Army. He's asking what other promising coins or tokens for the long run investing?
So I like for a long run, I suggest an index like the Bloomberg Galaxy Index will have a survivor bias. Trying to pick out the winners is very difficult right now, like Bitcoin and Ethereum. And the number three, those are the top three in the world. The third and the most widely traded in the planet is Tether. It's a digital dollar. So from a general standpoint, I want to point out the U.S. is crushing China in a Cold War right now, digitalization, by doing nothing, because the world wants dollars. So to me, this is something for the U.S. not to mess up with over-regulation, to embrace the technology. And I think that's what's happening. But as far as which one might be the next winner, I think Bitcoin and Ethereum are a great pair. And then I look at the Bloomberg Galaxy Crypto Index as a good way to measure the market. And at some point, there's plenty of indices out there you can track, and there'll be more and more we can get access to, like the S&P 500. But trying to pick stocks, I'm not good at that.
Got it. Mike, thank you so much. And I'm looking forward to seeing you in person at our next events after the summer. We have a lot coming. I should actually talk to you about that in New York, in Miami, in Dallas. So we will all look forward to seeing you in person. Thank you so much.